It's
8 months. I give all the evidence you
it's
wanted, and then I give your way back up and and I gave it. I added part to it, but I put it shelf. So why is it that you gave me 5? But I think it's supposed to be 4. Read this one, I know.
Right. So we look at now. There is a statement that it says sales of the chemicals are still buoyant, however, and are projected to account for 45% of Cooper Co's revenue for the year ended 31st March.
Which is about
So
10%.
if we take into consideration 31st January 2015, just the following year, the revenue of the company is more or less like 45% from that aspect, okay, that is ready to phase out in the next 3 years. So it has to, we can disclose it in the notes, not recognize it, but disclose in the notes as that aspect or those plans may be recognized as what? May be disclosed in the notes under IFRS what? 8. Operating note, segment. Okay? Just disclosure, not recognized, but may be disclosed in the notes as an operating segment because it is accounting for about 45% of the revenues of the company. So these are the things we consider. Then audit evidence we may be finding. 1, we need to obtain a copy of the government's regulation. Why do we need a copy of the government regulation? So that we want to know that the product will phase out.
And then the period stipulated for the phasing out of the period
Will phase out by 2017. That the product will phase out by 2017. So we need a copy of the government regulation. Then we also need to look out for the carrying amount. So we need to look at the agreeing of the carrying amount. So agreement of carrying amount in the asset register. In the asset register relating to the value of the factory. Relating to the value of the factories. Very important. Very important. Then we also need to review the forecast of the company. Okay? A review of the forecast. And the reason why we are reviewing the forecast is because we want to find out, confirm the amount of revenue still being generated by the factory. Confirm the amount of revenue still generated by the factory. What are I saying? Then
bank statements and cash to verify the expense, the 1 million.
Then we need to discuss with management concerning any future use of the factory. Whether they want to disclose it as a held for sale or something like that. So we need to discuss with them about that. Potential future use. Then certainly we could certainly we need to confirm that the research cost is included in operating expenses. So confirmation of research cost included in expenses, in operating expenses. And not capitalized. And not capitalized. So remember, what we are doing here is what could go wrong, the risks of material misstatement. So we need to find out to see if they have capitalized it or they have treated it as expenses. So that is what we do there. So Hannah, II, matters to consider, and then audit evidence. So what do we have there? In October 2013, Cooper Co's finance director Hannah Osborne purchased a car from the company. The carrying value of the car at the date of its disposal to Hannah was $50,000 and its market value was $75,000. Cooper Co raised an invoice for $50,000 in respect of the disposal, which is still outstanding for payment. Can you imagine that? Okay, so matters to consider. Now, if you check, she is the finance director of the company, and she has bought an asset from the company, a car, and she hasn't paid for it yet, still by the company. So what is happening here? We need to go straight and refer to IAS 24, which is related party. How? Because the way you answered it is not the way it has to be answered. Now, related party disclosure states that, members of key management personnel is a related party of the reporting entity. Are you getting it? So this standard states that members of key management are, or is a what? A member of a key management personnel is a what? Related party to the entity, to the reporting entity. As such, we need to properly, so that is the first thing, accounting for it. So they are related party, which means that Hannah, is it Hannah? Yeah, Hannah is what? A related party to the company. True or false? Sure. So she's a related party to the company. Also, according to ICAG 550, which is related party in audit, requires that auditors evaluate related party relationship and transactions are properly accounted for and disclosed. So, two things. One, IAS 24 states that a member of a key management personnel is a related party to the reporting entity. For that reason, HANA is a related party. Then, ISA 550, related parties require the auditor to evaluate related party relationship and the transactions that took place and find out whether they are properly accounted for and disclosed. So that is the matter we're going to be considering as auditors. What do you mean by that?
No, Unless means then the transaction should be in a way where as if they don't know each other, as if they are not related.
So we as auditors, we are not talking about accountants. We as auditors will just look at the fact that she is a related party. So it's not about it being arm's length or not. We are interested in has it been disclosed. That's why this statement is very important. We need to evaluate the relationship and find out whether the transaction has been disclosed as such.
Properly accounted for arm's length.
Properly what?
Accounted for means that arm's length. It's true. Because if you are checking
I understand what you are saying, but when you use that word here in relation to, it's not under ISA 550, it is under IAS 24.
Yes, so come and give me marks.
I won't give you any marks because it doesn't earn you any marks. Did you quote ISA 550?
Yes.
Where is it? You don't even know ISA 550. This is the first time you are hearing it. So that is it about that.
You just gather your energies from IC.
Yes. Don't come and
I know the brother, highest thing.
So that is the idea about that.
Take note.
So about this, we talk about the accounting standard, we talk about the ISA 550. So what are the audit evidence that we need to look out for?
I want to talk about IAS 16.
Where is IAS 16?
Because the thing was sold at the carrying value. When the market value, the market price of the fair value.
Why will you talk about IAS 16 here? Because in the first place, this thing is immaterial to the audit. If you want us to talk about materiality, that figure is immaterial. So we could further say that when it comes to related party in audit, there are two things. Amount and what? Nature. Based on the amount, it is immaterial. But it is because of the nature, that is why we need to what? Go over it. So we can't talk about IAS 16 here. Because it is immaterial in amount. But because of the nature in relation to IAS 24, we need to what? Audit it. I hope you are getting the idea. Because materiality, it will be somewhere like 0.02, which is nothing, which is immaterial. So we won't consider it. We won't consider it. Are you not seeing anything?
Transactions
are properly accounted for and disclosed. What evidence do we need? Number one, a review of the notes to the financial statement to confirm that sufficient disclosure has been made to comply with the IAS 24. Okay? Because remember we said it has to be what? Disclosed. Hence, a review of the notes to the financial statement, a review of the note to the financial statement to confirm that sufficient, very important, disclosure, to confirm that sufficient disclosure has been made to comply with IAS 24. IAS 24. So have they made sufficient disclosures? Very important. A review of or a copy of the invoice, a copy of the invoice should be obtained copy of the invoice is obtained and agreed with the trade receivables to confirm the outstanding, amount of the $50,000. So that invoice that was raised, you can say Monkofambra. Then we need to find out if there is any copy, so a copy of any other documents relating to the sales. Now when we say any other document relating to the sales, maybe she signed a contract with a company for the repayment, the time of the repayment. We need to obtain it. Okay? So example, a contract of payment or terms of sales. We need to obtain it and find out what were the terms of the sale. Why is the amount still outstanding? What are they from 2013 to you do 2014? Still won't you? Now the ben now bet you. Finance lease. Who is financing? Then we need to also confirm whether the carrying value has been removed from the assets. Confirmation of the removal of the carrying value of 50,000 from assets. Makes sense? Because they can say they've sold it, but still 50,000 is part of the assets of the company. No wonder she has not paid yet. So it's like company car, and so we are Tomaman. So we need to obtain that. That's also something important. Then, very important, we need to, there is this key point I wanted to raise. See if I have it here. We need to obtain a review of the management minutes. A review of management minutes. Why do we want to review the management minutes?
The confirmation of authorization.
That's it. So, to confirm the transaction, was appropriately authorized. Was appropriately authorized. Why are you talking about lease here?
I just what I'm so saying.
Into a lease asset from the company.
And I say IFRS 2.
Like a bonus scheme given to her.
The car.
Yeah, the difference could be a bonus because the market value of the car is 75,000. But we gave it to him at the carrying value 50,000. So the difference could be a bonus. But it's not relevant though.
Then I'm doing a quiet here on my report.
And you know what? So really don't know. Shucks.
Yeah.
So B. Max noticed that a section of the audit file had not been completed on the previous year's audit. The incomplete section relates to expenditure incurred in the year 2000 and in the year 31st January 2013, which appeared not to have been audited at all in the prior year. The expenditure of 1.2 miller was included in the development of an internally generated brand name. The amount was capitalized as an intangible asset at 31st January 2013, and the amount is still recognized at 31st January 2014. Okay, so what is that? Requirement. Explain the implication of this matter for the completion of the audit and any other professional issues raised. Recommending any action to be taken by the auditor. 5 marks. So what do we do here? What do we do here?
This thing is, although it's immaterial,
Who said it's immaterial?
It's immaterial to total assets.
Are you sure you're not lying? That it's immaterial. So number one, we need to talk about the fact that the situation raised here, okay? The scenario or the situation, we can use that word. The situation raises doubts about the quality control of the previous year audit. Agree?
I said that one.
So quality control procedures of the previous year audit. Makes sense? Of the previous year audit. Because we are told that they did not audit that thing at all in the last year. So that means in the previous year, they didn't do their job very well. Second thing, it is material misstatement because under IAS 38, intangible assets, what do we say? It is against the rule to recognize. So according to IAS 38, intangible asset, internally generated brand name cannot or must not be what? Be recognized. Cannot be recognized. So that is something they have breached. That is something they have breached. Cannot be, not that cannot be recognized, but cannot be capitalized. Let's use the word, because that's what they did. Cannot be capitalized. But if they do anything like that, they must expense it. Okay? Must be expensed. So it cannot be capitalized, but must be expensed. That's the second thing we talk about. The third thing is talking about the materiality of the amount involved. If you check the materiality of the amount involved to the statement of financial position, that's the balance sheet, the materiality will be 1.2 million over what?
240 million.
240 million. And that will be what?
0.5%.
0.5%. So it is immaterial to the statement of financial position. I'm coming with your in that you are saying. Statement of comprehensive income, 1.2 million over 15 million. Is it not material?
No.
That's going to be 6%, confirmed. And that is material. So it is immaterial to the balance sheet, but it is material to the statement of comprehensive income. Hence, we must go and look into 8%. Okay. Now, so these are the first three. The fourth thing we can talk about is that, assuming last year the financial statements were prepared well, and that the internally generated brand was not capitalized, then the last year profit would have been what? So if the amount was correctly accounted for, profit for 2013 would have been 18.8 million. True or false?
True.
Would have been 18.8 million. This indicates that the profit has been what? Overstated. Overstated. But we are also told that the amount is still recognized at the year end. Hence, according to IAS 8, accounting policies, according to IAS 8, accounting policies, estimates, change in accounting estimates, and errors, the amount must be what? Treated. The adjustment should be retrospectively done. Okay, that's the fourth thing we consider, or the fifth thing rather. So, quality of the audit is smelling. Intangible asset, you're not supposed to do that. Materiality, it's material, we got to consider it. The amount correctly accounted for would have been reduced the last year's profit, which means there has to be what? An adjustment, and it has to be retrospective. Retrospective means we go to last year and adjust what? The retained earnings. Sounds good? In the retained earnings. Because when I'm doing adjustments like this, it is the retained earnings that you go to. It is the retained earnings that you go to. But the key thing is this. The examiner, in addition to say, it says recommending any actions to be taken by the auditor. If we want to talk about actions, in this case, actions, the auditor must require management to make the adjustments. So auditors, but do you think auditors will do this? The auditor must recommend management to make the adjustment. That means they are bound. We couldn't do our work. So it is something we are supposed to do, but the auditor may not do it because it may affect what? Our professional competence and relationship with the organization. But it is something we are supposed to do. That's it. It means we didn't undertake the audit last year very well. So that means the auditor's report we issued may be smelling. I get in the idea.
Said there should be a provision for, we say,
so that is it. I don't know when you know about dream. So that is the idea about that. So these are some of the things we talk about. Remember, it's for 5 marks. Okay, so we are not supposed to write much, but as much as we can, we must make sure we touch every aspect of the question. Question 3. Malevich, whatever they have, or Malevich, sorry, Malevich. Malevich is so local. Malevich. So Malevich & Co., because this is a UK company, so Malevich & Co. is a firm of chartered accountants offering audit and assurance services to a large portfolio of clients. You are a manager in the audit department responsible for the audit of 2 clients, Kandishki Co. and then Ranchco University, both of which have a financial year ended 31st July 2015. The audits of both clients are being completed and you are reviewing issues which have been raised by the audit seniors. Kandishki Co. is a manufacturer of luxury food items including chocolate and other confectionery, which are often sold as gift items individually or in hampers containing a selection of expensive items from the range of products. Due to an economic recession, sales of products have fallen sharply this year and measures have been implemented to support the company's cash flows. you are aware that the company only has $150,000 in cash at the year end. Extract from the draft financial statements and other relevant information are given below. So we are given the 2014 and then comparative 2015 and the comparative of 2014, and we come to the notes. The bank loan was extended in March 2015 by drawing on the borrowing facilities offered by the bank. The loan carries a fixed interest rate and is secured on the company's property, including the head office and manufacturing sites. The first repayment of loan capital is due on 30th June 2016, when 350 is due to be paid. Okay, so first scenario, the money they have is now only 150, but they are supposed to pay in a year's time something about what? 350,000. But you got to understand that their loan has increased by how much? 500,000. We'll come back to that. Kandinsky Co. renegotiated its terms of trade with its main supplier of cocoa beans and extended payment terms from 50 days to what? 80 days in order to improve working capital. I think you all mentioned that thing when you were doing your analysis. Then the borrowing facilities are due to be reviewed by the bank in April 2016 and contain covenants including that interest cover is maintained at what? 2%, and the ratio of the bank loan to the operating profit does not exceed what? 4:1. The contingent liability relates to a letter of support which Kandinsky Co. has provided to its main supplier of cane sugar, which is facing difficult trading conditions. Required. In respect of the audit of Kandinsky Co., identify and explain the matters which may cast doubts on the company's ability to continue as a going concern. So what do we say? So that uti say me dey osere say me can this school na osere me ni baby adi ni po free sha ko fa di akete be se ko dem ma bo bi nke bo anu wa we nke na wako Mr. Chura ni din bi adi se me sa ko treso. So Kandinsky or Kandinsky, whatever it is. So identify and explain the matters which may cast doubt on the company's ability to continue as a what? Going concern. Alright? So the first thing we talk about under this thing is the revenue and profitability. Okay? That's the first thing we talk about. Now, if we talk about revenue and profitability, we have to look at the percentage fall. So we need to calculate the percentage fall in revenue. Who did that? Nobody, right? What is the percentage fall in revenue and percentage fall in profit? Can we calculate that quickly? Please calculate that for us. The revenue will be 343950 minus 2440 divided by. That's 38.23%. And then percentage fall in the profit. Can you see the profit? Yes. It's actually a loss. Yeah, so that one to like not like. Is it? No, percentage fall not in the final profit but operating profit. How do you get operating profit? By subtracting the operating expense. You subtract the operating expense from what? The profit nankasa. Fachoya 2015 ai. 340 and then 2014. So percentage fall, you do the calculation. Yes, please. The next one is 340. The second one is 1150. Yeah. 70%. Hey. So papa. Now, revenue is falling. Profitability is falling. The company is making losses. However, you need to state categorically that the loss making, okay, in its own right does not indicate any what? Going concern issue. So that's the key thing. So the fact that the company is big, because there are some companies that can sustain losses over a long period of time. So the loss making in its own self or itself doesn't mean that the company is not a going concern. So that's the first thing we talk about, profitability and revenue. Second thing is to talk about the bank loan. In talking about the bank loan, you will see that the bank loan is secured on the assets of the company. What does it mean? That is when Anaja, you said something. It is secured on the assets of the company, which means that when the company goes into administration, right, that asset will be taken over by the bank, which means that asset will be taken over by the bank. However, in addition to the bank, there is a repayment of how much? We need to make a repayment of how much? But before the repayment, let me also talk about this. Bank loan has increased by how much? By $500,000. I don't know if you realize it. Last year it was 3,000. Now it is 3,500. So it has increased by 500,000. Now, what does this tell us as auditors? No, not jeering alone. But this could mean that, the company is financing operating expenses with what? Long-term loan, which is strategically unsound. So it is something we have to mention. So meaning the entity or the company is financing operating expenses with long-term loan. This is strategically unsound. It's more or less like what Bodam. The company is going to Bodam. Then the repayment. There is no sufficient cash available. For the repayment due. So that's something we need to also talk about. That's the second thing. Third, we come to the borrowing facility. Borrowing facilities. Now, refer to your question and let me say something there. You see the note 3 on drawn borrowing facilities. What does it mean? It means that the company has a right to borrow this money, the 500,000. But to borrow this money, it is subject to a covenant. And what is the covenant? The covenant is that the interest cover must be at 2. And then the ratio of the bank loan to operating profit should not also exceed what? 4.5. So talking about the borrowing facilities, we need to find out, can the company qualify to take that extra 500,000? For that reason, we need to calculate the interest cover. Can you do that for me? 2015, 2014. So 2015 is going to be 340, the operating expenses over what? 520. And this is 1150 over 500. Then interest cover is not in percentages. So So 0.65. Interest cover is times. How many times the operating profits can cover the interest expenses? So that's not times anything. This one.
1.
1.
No, 0.65 is to 1. No, I'm thinking of the.
Yeah, it's to 1, yeah.
Value like 500. 2.3.
2.3. Then the borrowing to the operating profit. That one, the borrowing is 3,500 for 2015. Operating profit is 340. Then 2014, borrowing is 3,000. And operating is 1150. So let's see what we have.
10.3.
10.3 is to 1. And then
Divided by 150. That's 2.6.
2.6 is to 1. So if you check, do you think the company can take this?
Nope. But the ratio is 4 is to 2.
Yeah.
But now it's 10.3 is to 1.
So you could see that the company is what? So the entity may not be able to withdraw or to access the facility because of the covenant. This is a covenant keeping what? Because of the covenant. So you see that they are borrowing. They say it shouldn't exceed 4. Should it be on 10.3? This one shouldn't exceed 2. Sorry, shouldn't fall below 2. But they are at what? 0.6. So certainly they will not be able to go through it. And then lastly, the contingency liability. That letter of support they issued, what is the meaning of that?
Now I do not what do they call that? Do not the ISS.
The letter of support offered
We have legal
to a supplier